is decision day. The Monetary Policy Committee will today announce the decisions it has reached with regards rates, foreign exchange, and of course the markets are looking and waiting very anxiously for these figures to be announced later on today. But we're talking about the markets in just a bit. Yesterday, we saw the Nigerian Stock Exchange bearish movement. The key indicator dropped about 0.37% to 27,015.97. Market capitalization came in at 9.27 trillion naira. Total number of deals done was 3,924. Volume came in at 316.73 and a value of 1.90 billion naira. So yesterday alone, the market lost about 34.74 billion naira. Maybe getting in anticipation, of course, for whatever announcements will be made by the Monetary Policy Committee. But I'm talking to the Chief Economic Officer of Meristem Securities Limited now. Her name is Kemi Akinde. She'll be talking to us about what the markets expect. If yesterday, from the equities market alone, we saw about almost 35 billion naira dropping, what will the rest of the week be like? Good morning to you, Kemi. Thank you so much for coming on the program.
Thank you.
So, first off, what do you think the rates decision will be today at the end of the meeting?
Okay, Aristotle said something very profound in his classic on politics. He said, he who considers a matter from its first growth and origin will have the clearest view of all. And I think appreciation of the evolution of the current headwinds we are facing now is critical in designing an optimal policy mix that will maximize the likelihood of any decision the MPC is going to take, especially in fulfillment of their objective. Now, be that as it may, being short-termism can also jeopardize the success. So I think the MPC should actually have a double weighting, even multiple weighting, on the likely path of these key macroeconomic variables, rather than just focusing on, the immediate environment. And the MPC is meeting at a time when series of downbeat data, negative news flow, are not just affecting the economy, but dominating the economy. GDP growth, as in GDP contraction, for the first time in how many years, ever since the rebasing. And if we place this in the context of developments that have occurred so far in Q2, it sends a signal that based on the most common definition of recession, that might be slipping into recession. You see inflation looming larger, you see unemployment pushing higher, and all these things will affect the decision the MPC is going to take. Now, 4 key things: NPR, inflation, FX, and maybe the banking system, given the developments that have occurred in recent times. Now, for FX, as I said, appreciating the evolution is very key. The issue we're having is supply constraint in the face of a relatively inelastic, demand. And how do you increase supply? You earn your FX via exports, or you import it via FDI and FPI. Export needs time to gain traction, considering global weakness in demand and also slumping commodity prices. For FDI and FPI, very good, especially when you have tremendous, growth prospects in an economy. However, it is only operational where you have high capital mobility, especially for outward capital flows. So foreign investors are not so much concerned about the level of the effects, but much more about the volatility. Imagine what happened in the last 2 weeks from 322 naira to $1, moving up to like 355 to $1. So it's about the volatility. And when foreign investors are coming, they model the tail risk, worst case scenario. And on a risk-adjusted basis, is the return still very attractive? Now, what informed the last increase in the policy rate? Policy rates, inflation at 11.3% has made policy rates to be negative in real terms. We can take policy rate to be proxy for maybe yields in the environment, because policy rates being negative is not so much of the key issue. But what happened is there are things that will lead us to say, okay, fine, they should hike rates because of the pronouncement they've made, in recent times, the CBN governor, and also because of what happened at the last MPC, which has repeated itself at this MPC. So you can say, okay, they will hike rates. But if you look at what happened yesterday in the markets with respect to yields, you might say most likely they might not hike rates. Yes, the fixed income segment, that most likely there might not be an increase in yields. But we had a position that we don't think it is optimal for them to hike rates at this point in time. Even if you hike rate, they want the yields on domestic instruments to be attractive or competitive. And that was the key reason, one of the key reasons they hike rates at the last time. But if you consider it across emerging markets, even for the next level, Nigeria has the highest policy rate, and still capital importation has been dropping. So it tells us that on a risk-adjusted basis, that yield environment is still not attractive to actually drawing the funds. So we don't think they should hike rates at this meeting.
So a no to a rate hike. But then why the market seems to be pricing this in already?
What happened? We have an opinion that they should not. However, if we go by what happened at the last meeting, policy rate negative in real terms, so we've got to increase rates. Now again, policy rate has become negative in real terms. So it just presupposes, if you go by the principle of consistency, that they should hike rates. But the market is actually not reflecting that.
So what contributed to the loss that we saw yesterday at the equities market? It seems as if investors are taking position. We saw 34.74 billion naira loss at the market. Market capitalization actually dropped.
We don't just look at the equities market. Look at it vis-a-vis the bond market. Now, fine, they have led people on a path. As I say, when that decision was taken at that time, and when other pronouncements were made that there's going to be a likely hike, in the policy rate, the market price that in bond yields actually, advanced. But now, what made bond yields to actually slump between like 2 days ago and yesterday? So that actually gives us an indication that they might not. And our own recommendation is that we don't think they should go in by a number of things. The impact of that on borrowing costs, on lending rates, is going to be killing for businesses. So if you actually want to have a positive real return, you can do it in different ways. If you hike NPR, the burden is going to be much on the private sector, but you can also do a kind of liquidity management to actually affect yields upwards. I'm going to achieve the same thing, but with lesser burden on the private sector. So,
what do you think the market's actually waiting for now? Because talking to a stockbroker yesterday, it seems as if, as you already rightly mentioned, the market has priced this in, but they're still very tepid, staying on the sidelines with regards to trading very actively, even though we saw very good activity, at the treasury bills and the bonds market yesterday.
Now, I think interest rate is one issue. As I also said, there's another issue of devaluation. There is expectation, for devaluation. And maybe one of the things actually informed that is, MSCI said they were most likely going to take us, reclassify Nigeria as a stand-alone market from the frontier market.
Because of the
But
FX
that
challenges.
decision was kind of, rescinded. And what happened? They said if there is a potential mitigating plan. So that then presupposes that, okay, possibly there was a potential mitigating plan that made them actually, not take that decision. And the first thing you could think of is, what could that be? Maybe a devaluation. And that's why people that's why there is that news that most likely they're going to devalue. But it looks like an either-or decision. If they would devalue, why would they move the bulk of FX demand, which is importation of crude, move it from the official market and literally to the other market, into bank and the parallel market? So if devaluation is in the offing, it doesn't synchronize with that particular decision. So it looks like an either-or. But there is that expectation of devaluation. And another thing is this: if you're saying devaluation, what targets are you actually chasing? Devalue to what? Oh, to 250. What informs 250? Devalue to what? 285. What informs 285? The pricing mechanism for the oil importers. Or devalue to. So it's like there was a time there was a consensus. Devalue to 220. And that was when the parallel market was at 220 for a substantial, of an extended period of time, and it was okay. It felt that is the true value of the naira, but it has since moved from that. So even we're talking about devaluation, as I said, the issue is FX constraints. Devaluation will not bring in the funds. Imagine market risks have heightened, and as a global portfolio manager, you're allocating your funds, and you're considering the risk-adjusted return. The returns are fantastic, good, but how about the risk? Imagine a foreign investor who even decide to take short term. Okay, it's been stable as 323 naira to $1. Let me come in a month, 2 months, and I exit. Imagine what happened in the last 2 weeks. So that volatility is still there. That risk is still there. So we don't think devaluation is actually the solution to the problem. It is not going to increase that FX supply to the point that we can actually have that equilibrium in the market.
So with the scenarios that you've painted now, you're firmly of the belief that the MPC should not take any decision just yet, just continue to watch how things play out on the domestic and international markets. So what should their decision be at the end of today? Hold NPR at the rate it is right now, which is about 11-12%. maintain stability, of course, status quo on cash reserve requirement for public and private sector deposits, and also stay status quo on exchange rate.
On exchange rate. However, we think that they should do something about the current trading system. As I said, devaluation really, it's not an optimal, solution. Given the issues of supply constraint, it's not going to increase supply flow. Now, the current trading system needs to be reformed. And I know that the last MPC meeting, they actually said they are working on a comprehensive reform of the current FX. So that is a decision we think that they should take. However, they might not take it as the sitting, but it's something that is being worked on. So the decision, I think, will be is going to be more on reforming that FX system. But I say it might not be announced, at the system. But I'm sure there'll be emphasis on it, and maybe most likely, steps that have been taken, up until.
Kemi, so, like you rightly mentioned already, the MSCI Frontier Markets Index was one, issue that really raised a lot of hackles for us, especially since we had just been exited from JP Morgan and Barclays as well. So one of the issues they actually talked about was, watching the how accessible is the market, and they're also looking at the other issues with regards to investments, particularly around the corridor of FX management. Don't also forget, the International Monetary Fund has advised continuously that Nigeria should begin to look at readjustment of its currency management. So the scenarios that you've played out, some investors, might actually toe that line. But in light of realities, in light of the fact that we still have, we're literally importing inflation, and we're seeing inflation numbers most likely continue to trend upwards. 13.7% right now. You talked about GDP figures coming in, probably contracting again in the next month. And so with all of that scenario playing in their mind, and the decisions that need to be made.
Okay, now, inflation is cost push. Even if you increase MPR, it's not going to tame inflation. It will only make cost of production to go higher, and of course, it's going to fuel the inflation pressures. With regards to IMF, I think someone is going to talk to the IMF, really. IMF is advising on fiscal consolidation at this point in time. Consumption is weak. Business investment is sluggish. Net export is not gaining momentum. Only government expenditure can actually drive growth in the economy. And then you say, fiscal consolidation, trim your spending, trim your expenditure, try to grow your revenue. In this case, you're going to stifle the economy to a point where we'll make recourse to them. And then at the end of the day, they are going to eventually micromanage the economy. So I really want to take to the IMF decision. IMF said go for a tightening monetary policy stance, although there's going to be adverse impacts on the private sector, but it's just momentarily, but go for it. What will he achieve? Because we want to foreign flows to actually come in. Russia tried it. 17%, they came down to 12.5%. Now, we can even discount that, for the sanctions on Russia. A whole lot of other countries have actually taken that, but it has still, because of the heightened, risk for emerging markets, it has not attracted that foreign funds as much as it should be. And I say, in the class of next 11, Nigeria has the highest policy rate, has the highest yield environment, still the funds are not flowing. So how far can you take it to attract funds into the economy? So, and I say it has to be, when you're talking about returns, the yield environment being attractive, you need to match it with the risk also in the environment. So I think that's where the issue. I say it's not just about the level, but the volatility. When exchange rate moved from 119 to 145, it was massive, but it was stable at that rate for a period of time. Then to 156, stable at that rate for a period of time, and then you can plan. So I think it's more about the stability than just the level that they are concerned about.
Okay, so keep our eye on the markets and wait for the announcement, which will be coming up much later. And of course, I know I'm going to get Mary Stem's thoughts on this as well. Thank you so much, Kemi, for coming on the program this morning.